Hello, everyone. On today's edition of The Final Bar, my guest is Greg Harmon from Dragonfly Capital, fellow Cleveland native. He's going to be sharing his long-term charts, a couple charts telling him about the big picture in the equity universe. Also, we'll do our popular mystery chart segment, sharing with you a chart that you may or may not guess, but should definitely be aware of. We're also going to do a new segment called Banking on Breadth, where we talk about breadth characteristics of the market, why it's important for the coming days, coming weeks. Ladies and gentlemen, this is The Final Bar. Hey everyone, welcome to today's edition of The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks so much for joining us today. Every weekday after the close to debrief on what's happened in the markets today, try as much as we can to connect it to the long-term trends. And I think that's so important for long-term investors to not get too caught up in the short-term fluctuations, the news headlines, the headline risk, the geopolitical fluctuations and all the news flow, but really focusing on the long-term trends and where the momentum is headed. That's what I think more than anything is going to keep you on the right side of things. It's interesting, my guest today is Greg Harmon from Dragonfly Capital. He's shared a couple charts which are very long-term in nature, and I love that. A number of our guests recently have really focused on the long-term, and it's so helpful, again, to just have a proper long-term perspective. So excited to hear from Greg looking at the broad equity markets, also on cryptocurrencies, which should be kind of interesting. Today we have a number of really interesting segments. We're going to have the mystery chart, which is a popular segment where we cover up the ticker, share with you the chart, see if you can guess what it is, and then share why it's an important thing to pay attention to. Also a new segment today called Banking on Breadth, which is going to be a fun way of looking at breadth characteristics of the markets. One of the most important things you can look at besides the broad S&P 500 chart. Before we get to all of that and recap the markets, I did want to share with you some of the things coming up schedule-wise. So coming up on the 27th, we have Mark Ungewitter. On January 28th, next week, we have Dana Lyons. On January 29th, we will unveil our first documentary-style special highlighting our visit with Ralph Acampor at his barn where we painted the world's largest Dow Jones Industrial Average as far as I could tell. I did want to point out our 2020 market outlook just premiered today earlier on StockCharts TV. We're going to be showing it again this evening at 6:30 p.m. Eastern. So if you missed it earlier, just keep StockCharts TV up until 6:30. You'll see it there. We'll also post it on YouTube later so you can see all of my fellow contributors sort of what we're seeing for the equity and other asset class markets going through the course of 2020. Let's get right to our market recap. So a lot of movements today. It's interesting. If you look at the days trading on the S&P, we had this nice jump higher. It felt like it was going to be this great continuation of the previous trend, sort of step on the gas, continue to the upside. But if you look, the S&P 500 finished about flat, actually. Finished toward the lows of the day, really finished in a period of weakness. A little more profit taking during the course of the day than we've seen in previous sessions. Although yesterday we also had that going into the close. So a bit of a last 30-minute pattern of showing relative weakness. In general, that indicates institutions sort of taking profits. But again, that has happened in previous weeks, and the uptrend seems to have continued unabated. So, but overall, that's what we're seeing. So the S&P flat, small and mid caps also flat, finished a little bit weaker, but just a rounding error, not much different. So overall, it was sort of a yawner in terms of directional movement. After some of these days where we've had big, significant fluctuations, bit of a lighter movement. Now, what we have seen, though, is a continuation of the strength in technology. So tech was up the most out of all the sectors in the U.S., followed by utilities, followed by financials. One of our 3 and 3 charts yesterday was on the real estate ETF, XLRE. This is the XLU utilities. And it's interesting to note how utilities and real estate overall have been in a stronger position at a time when it feels like those should be more lagging. Today we have real estate toward the bottom of the list, which kind of makes sense, but here you have utilities back up at the top. So, again, I always try to remind people, just because you think the market is doing one thing, don't just make a sector bet expecting the traditional sector relationships to work out. That's why looking at the charts of some of these ETFs can be so informative. Energy continues to be a drag on performance. And again, from a technical perspective, I think you would be hard pressed to justify wanting to own something like the XLE here on the long side based on this continued underperformance until you see some sort of accumulation, some sort of injection of upside of some sort of buying pressure. Have not seen it yet with energy. Looking at a long-term chart of the S&P, this is looking at the last 1 year, and just to remind us where the trend has been. We had this consolidation, late summer going into fall of last year. We then had the rally in October, pushing the market again to new highs, well above the 3,000 level. So far has not looked back. A bit of a pullback beginning in December, but then has continued to the upside. And look at year to date, we've just continued this nice bullish run. Sort of the end of year wasn't even that much of a hiccup, right? Just sort of continued to the upside. Now we have this situation where the S&P has become consistently overbought, right? With an RSI remaining above the 70 level. I think a lot of people see this sort of pattern like we saw last November and incorrectly think, all right, the market's gone too high too quick, we're gonna have a pullback. That does happen sometimes. You saw here at the end of April of last year, you did have that situation, became overbought, market sold off for the next couple weeks, that's totally fair, but it doesn't always happen. And in a period of extended bull phases, when the market just continues to go higher and higher and higher, a market can become overbought and remain overbought. And that seems to be what we have seen here. Any opportunity we've seen for a bearish divergence really has not materialized. The RSI has continued to go higher. Prices continue to go higher. And again, as long as we continue to have this pattern of higher highs, higher lows, the uptrend is in decent shape. 3210 is the most obvious support level. There's no real resistance because we're at new all-time highs again. But any sort of pullback, 3210 is sort of the line in the sand that I would be paying attention to just to see where we're at relative to some of those levels. It will be interesting to note in some of the equity movers, IBM was really one of the drivers of tech outperformance today. Tech was the #1 sector. IBM jumping higher, going well above 140, a nice gap up, even though it pulled back a little bit, closed more in the bottom half of trading today, still a much higher level than we were yesterday, which is really sort of continuing this upside. You also have Abbott Labs, ABT, within healthcare, and Capital One Financial, COF. So the new scooter movers list, the ones with the biggest gain in their scooter rankings, a lot of different sectors actually represented there. It's not just very specific on individual names. I think it's worth noting on the downside, Netflix, which is a big name. A lot of people have exposure to either directly with the stock or through an ETF. If you hold a broad market ETF, you're going to have a decent Netflix exposure in there, down pretty heavily. So you have this divergence of some stocks working, some stocks not, and that is pretty characteristic of an earnings week from what I've seen, because you'll have companies that are sort of polar. Either they do great or they do really poorly based on the news headlines of the day. I did want to point out down on the industries leading, fixed line telecom popping up, which is an interesting one, more of a defensive group traditionally, but you have some names there, AT&T, Verizon, which are really more 5G bets as well. Also, semiconductors, one of the biggest names, biggest industry gainers, computer services. These are two big groups within technology. And again, something like semiconductors continuing to work has to make you feel pretty good about the overall health of the equity market. As usual, we've just been able to touch on some of the themes. I'd encourage you to spend some time on your own member dashboard. Look at each of these charts, drill into them a little more in a little more detail. You're going to get hopefully a pretty good overview of what's happening with the charts. Let's move on to our next segment. I want to introduce the mystery chart. If this is your first time watching the show, welcome on. And please, the idea of this is to show you a chart, cover up the tickers, which I'm doing here. And the question is, what is this chart? You can answer that by going into the Q&A window on the StockCharts TV page. Put in a guess, just put in a ticker, put in a name, whatever you think it might be. The only hint I will give you here is this is a tradable, U.S. tradable security. It's not a foreign stock, foreign ETF, foreign fund, anything like that. It's a U.S. listed security. The question is, what is this? What ticker is it? Put in a guess. Later in the show, we're going to reveal your guesses. I'll make some comments on what I've seen, and then I'll share with you what it is and why it's an important chart to pay attention to. We, however, for now, we're going to move on to our next segment, which is called Banking on Breadth. So one of the new segments we came up with was really focusing on breadth characteristics. A lot of times people throw around data about advanced decliners or the McClellan oscillator, percent of stocks above a moving average, all of these different ways of measuring market breadth. So I want to talk a little bit about what breadth is, why it's important to my process, and then I'll walk you through my chart list, which actually focuses on breadth indicators. Hopefully these are indicators that you're familiar with. If not, hopefully I can introduce some of the new ways of measuring market breadth with the goal of just understanding what they're telling you now about the current market environment. So I sort of have three ways that I think of broad equity markets besides just the overall averages and styles, different individual tickers. What are all the other ways you can qualify what you're seeing with the price of a major broad market index, with the price of the S&P? There's three categories that I would break it down on. Number one is breadth, which is looking at participation. This is telling you what percent of stocks are showing certain characteristics that are similar to what the broad market is doing. And I'll walk you through some of those ways. Just so you know, the other ones, and maybe we'll do future segments on some of these as well. The second one is sentiment, which is how people are voting, in terms of what they're saying. Are they getting nervous? Are they getting excited? Are they optimistic? Are they pessimistic? What are they feeling about the market? And we have different ways of measuring that in terms of volatility, in terms of survey data, actually asking people if they're bullish or bearish. That's a whole separate window. And then the third are with price ratios. Can we look at relationships between different markets and use those to qualify what we're seeing on the broad charts of the S&P and other broad indexes? So today we're going to focus on the first of those three, which is breadth, and talk about what it means. So again, for me, breadth means participation. It means how are stocks actually, what are they doing relative to what the broad market is doing? I'm going to go through each of these charts very quickly and hopefully hit on what they are, what they mean, and then in particular, what they're telling you about the current market environment. So the first couple deal with breadth in the form of where stocks are relative to their 200-day moving average. So at the top, we have the S&P 500, the 50-day in pink, the 200-day in sort of this reddish orange. So the idea is right now the S&P 500 is above the 50 and above the 200-day moving average. Both of those are sloping higher. At the bottom, we're actually saying, let me look at all 500 stocks on the S&P or all the stocks listed in the New York Stock Exchange. Where are they relative to their 50 and 200-day moving averages? So right now, the S&P is above its 200-day, but I can see that 73% of the stocks on the NYSE are also above their 200-day. 84% of the stocks in the S&P 500 are above their 200-day moving average. So even though the market is above the 200-day, 1 in 4 stocks is actually still below its 200-day, is not broken back above there. Now, of course, that's a lot of energy, a lot of stocks that have been beaten down, totally fair. But what you like to look at is what the market is doing as a whole, then glance down and get some qualification from breadth. So what I'm seeing here on the first chart is on the S&P 500, over 80% of the S&P names are above their 200-day moving average. That's a very high reading. If you look back in the last couple years, the only time it's been that high, 80 to 85 or more, is at previous market tops, cyclical tops here in mid-2016, early 2017, early 2018. If you look back further, though, you'll find that in an extended bull run, when the market really gets heated and continues on there for a while, so 2011, 12, 13, back in that period, this level can actually remain pretty elevated for quite a good period of time. So the question right now is this a short-term cyclical top like we saw in the current sort of cycle in the last 5 years, or is it more like the early 2010s where you saw extended bull moves, long and strong up and to the right with extended breadth? That's the question remains unanswered for the moment. This next chart is looking at the S&P and then the percent of stocks above their 200-day, percent of stocks above their 50-day. So what happens a lot of times is they can have short-term fluctuations go above and below the 50-day moving average, but remain one side or the other of the 200-day. So it's more of a short-term read on that. Also pretty elevated, lines up with previous periods of market strength. So in my opinion, no real signal here. One of the things we were looking at last year was this divergence of the market going to new highs, but lower highs in this breadth measure. But I think that's sort of resolved in the new year, in the last couple months, really. This has just continued to increase as more and more stocks have traded back in a position of strength. So overall, this is pretty positive, lining up with previous tops, and I think that's the red flag nature of it. But again, it's not shown us any sort of signal that it's reversing. Another way people love to look at breadth is the form of advancers, decliners. This is something you can look at during the trading day. So a lot of times you can just see, as of right now, what percent of stocks are up on the day or down on the day. What this is then doing is showing those values over time. So green, this is the advancers as a percentage of the total names. This is decliners as a percent of the total name. This is on broad New York Stock Exchange, so pretty broad equity universe. And one of the things I highlighted here going into year end was you had the situation of more and more decliners in an up market. It was actually kind of unusual. Again, that sort of resolved on its own going into the new year. You continue to see an elevated number of new highs. Of advancers relative to decliners. Today was actually pretty interesting. The market closed about flat, and it was almost exactly 50-50 between advancers and decliners. So it's really telling you it was a digestion day, which is what I call not a big correction, but just sort of a digesting the previous move. No real directional move. It's a pause before the next momentum move up or down in the market. This next one, we're looking at stocks making new 52-week highs and new 52-week lows in green and in red. And here we're looking at the broad New York Stock Exchange. At the bottom, we're looking at the S&P 500. My observation here is looking at the extreme number of new highs. As the S&P has gone higher, you had this situation where you have new highs in the S&P, but not a ton of S&P names actually making new 52-week highs as well. That has changed. So you actually have seen a lot of stocks making a new 52-week high. End of last week, beginning of this week, you had a third of the S&P making a new 52-week high all on the same day. It shows you how significant that is. You also have not had a lot of stocks making a new 52-week low, showing you how polarized it is. If stocks are overall going up in a very big way, and that's what that's telling you. We then have a number of ways of trying to accumulate that data. So this is cumulative advanced decline line. So taking that previous reading, but adding those figures over time, overall remaining in a position of strength. This is new highs minus new lows. As this goes higher, it tells you overall more new highs than new lows. That makes sense. This is up and down volume. So volume on up and down days, also positive. The final one I want to show you, though, is the McClellan oscillator. This is looking at advancers, decliners, but using exponential moving averages to smooth it out over time. When the McClellan oscillator is above zero, overall, the breadth characteristics are positive. Below zero, it's more negative. This is a little more of a shorter term read, and it's interesting to know the McClellan oscillator just testing the zero level. It's gone lower before, and the last time it really got negative was in the beginning of August, which is a bit of a pullback in equity markets. Also the beginning of October, lesser so at the beginning of December. So it'll be interesting to see if we continue to see this go down. It would show a little more distribution than we might see in the broader chart of the S&P. This is the summation index, which takes that McClellan oscillator, accumulates those values over time, overall going higher, telling you that that the market is in a decent shape breadth-wise. So to summarize that segment on banking on breadth, I would say overall, the average breadth indicator, very strong, confirming this uptrend we've had. There are certain things that are at extremes, and the one that concerns me is the percent of stocks above their moving averages, which is at an elevated level. That is not necessarily a bad thing, but it certainly could be, and it lines up with some previous tops, and I would want to wait for some sort of confirmation from the chart of the S&P itself. That's it for the beginning of the show. We're going to take a quick commercial break. Be back with my guest, Greg Harmon of Dragonfly Capital. See you in a minute.
I was staring at the north wall of my barn. Okay. It's 70 feet long, it's about 18 feet high, and just blank. And I said to myself, 2017, I'm going to be 50 years in the business. Wouldn't it be cool if I could just put the history of the stock market? That's where the idea came from. I wanted to capture my 50 years.
Everyone, welcome back to our show, The Final Bar. Thanks for joining us every weekday. Please keep your questions and your feedback coming. We'll be doing another mailbag segment very soon. You can get your questions to us anytime at thefinalbar@stockcharts.com. Just shoot us an email, or during the show, just put a comment in the Q&A segment. We'll grab those and consider them for a future broadcast. So thanks for keeping your questions and your feedback coming to us. I would like to bring on our guest, Greg Harmon from Dragonfly Capital. Greg, it is such a pleasure to have a fellow Clevelander on the show. Thanks for joining us, my friend.
Thanks for having me, Dave.
So you sent two charts ahead of time, and I appreciate the long-term nature of these. I always am trying to remind the viewers, don't get too caught up in the short term. Think about the long term. So this first one is a monthly chart of the S&P 500. What are you seeing here?
Well, this is my attempt at Elliott wave, combined with some just typical chart pattern breaks as well. And I've been tracking it on this chart particularly since that date down at the bottom, November 2010, and it's been keeping me on the right side so far. What I'm seeing here is that we're in the first wave of the final major wave heading higher. And Yeah, right where you're looking there with the one. And you can see that when you look at the RSI, the momentum indicators, the RSI and the MACD, they're both at pretty high levels. We're getting back to slightly overbought areas on the RSI and to kind of extreme levels on the MACD. So it kind of fits in with the story you were telling there about breadth just a few minutes ago, that we've got the potential here that maybe we are going to print a one and start just a quick second wave, which would be more of a digestive wave in the short run. But the long run looks like there's still a lot more upside potential.
That's really, really interesting. What I love about Elliott Wave, I love the way that it illustrates the characteristics of the behavior of the market, right, of the participants, and here sort of capturing, I think what you're illustrating, it's capturing sort of the resiliency of what we've seen. That there's a lot of further upside, but in the short term, a little more extended, right?
Yeah, short term and maybe a bit extended. I've been talking to subscribers about being maybe a little bit extended over the last couple of weeks now.
So it's interesting. If we can just stay on this for a second, we have a second chart on Bitcoin, which I want to get to. But with something like this, what would be the alternate hypothesis, or what would be something that you would see which would tell you, okay, this is not a wave 5. This is something more of it, maybe a significant top, right? How do you differentiate a healthy pullback within the uptrend versus the top that you have to be more cautious about? What would you want to see or on this sort of chart to help you see that?
Well, I get a lot of comments from people about my Elliott Wave charting, so that I can tell you what people look for. And many would tell me that where I put the 3 or the B was the end of the wave. Sure. And now we're going through just an overshoot. And once the overshoot's done, we will start heading lower. I think from a more practical perspective, because Elliott Wave, I think, is really hard to trade off of. It's a nice guide for me. But from a more practical perspective, I look at the RSI up at the top there.
Okay.
And we've got the peak from the beginning of 2018, and we've got the lower peak in 2019. And so far, we haven't been able to break over that peak. We've got essentially a diverging momentum. Momentum is diverging to the downside while price is going to the upside. And that's another reason to take a look at, maybe we're about to do something more drastic.
That's fantastic. Now, the second chart you sent, which I want to get to now, is the chart of Bitcoin. We've talked about cryptocurrencies on the show occasionally going back the last couple months. What are you seeing here from a big picture perspective?
Yeah, from a big picture perspective, the moving average I've got on there is a 12-month moving average to kind of get close to mimicking a 200-day moving average. And we see that when we had the big spike at the end of 2017, where we hit up to 20,000, started to pull back in a falling wedge pattern. And when we broke that wedge pattern, had a nice rally in 2019. It seems like we're going through the possibility of another falling wedge happening. Now, we've got 7 more trading days left in the month, so that candle that's breaking out there now may fall back in still. So can't trade off of that yet. But I also look at the Japanese candlestick formation there, those last 3 candles. And even if we hold up here a little bit on the January candle, you've got a morning star reversal building in here, which would definitely be a signal to start to get long Bitcoin. Combine that with the RSI turning back up after catching itself at the midline, and you see if we do see the price for January head up and then maybe a little into February continuation, we'll have set a higher low. So it's setting up for a potential promising move.
Greg, those are 2 fantastic charts. Thanks for giving us a good long-term perspective. It's such a great way of showing the benefit, I think, of charting, not just to look at the short-term movements, but really thinking about the long-term. So thank you so much, and thanks again for coming on the show, Greg.
Yeah, thanks for having me, Dave.
Folks, that was Greg Harmon from Dragonfly Capital. Two fantastic charts. And again, we've always talked about the importance of connecting the short term to the long term. And it shows what sort of color, what sort of insights you can get even from monthly candlestick charts, really looking at the long term. So thanks again to Greg for two fantastic charts. We, however, need to start wrapping up the show. Our next segment is called the Mystery Chart. We showed it earlier. What guesses do we have? SPY, the S&P 500. Fair guess. URTH, that's a great guess. That's actually the the S&P World ETF, ACWI World ETF, something like that. That is actually correct. Go Team Final Bar, resilient as always, picking out the charts. So it is not the S&P 500. This is actually the Earth, the URTH, which is the Earth ETF. It gives you basically exposure to the broad equity universe, 50% US, about 50% non-US, so it's a mix of all global names, including American stocks. What's interesting about this chart and why I think it's so important right now, my guest recently, Katie Stockton, was looking at the relative performance of EFA, global developed stocks, also EM, emerging markets versus the S&P 500, and this theme of the US outperforming the world or the world underperforming the US, at some point that's going to start to fluctuate. I think a lot of people will probably be caught on the wrong side of that. This shows you this chart of the Earth ETF in an uptrend, but look at how the relative strength continues to be depressed. And the problem there is you're getting paid on an absolute basis, but you're not getting paid on the relative, meaning it's better as a US-based investor up until now to still be leaning very heavily toward domestic stocks because they've just been stronger on a relative basis. So this is an important chart that I would be watching for a couple reasons. Number one, does this trend continue higher? Does the the momentum RSI remain positive, remain elevated? Does this relative strength profile start to turn a little bit? And if and when that does, you may want to be thinking about your non-US allocation and see if there's something to be thinking about. Has not happened yet. So it shows even though the equity world is going up, the US equity market is really where the relative performance is. So thanks for those guesses. Congrats to Team Final Bar once again coming through very nicely. We, however, need to wrap up the show with our 3 in 3. So at the end of every show, 3 charts in 3 minutes. If these are not on your radar yet, I would encourage you to put them on immediately. Number one is the McClellan Oscillator. We did our segment earlier on banking on breadth, which is, again, just a survey of some of the main, most widely used breadth tools. And one of them that I've used for years, and definitely working with StockCharts and talking with Tom McClellan, local here in the Seattle area, I've enjoyed thinking more about the McClellan Oscillator. I love the fact that it's based on advanced decliners, but it's designed to smooth out the noise. Advanced decliners can actually be a pretty noisy data series. The McClellan Oscillator is meant to sort of smooth that out. So the McClellan Oscillator on its own is looking at strength and weakness. Above 0 is strong, below 0 is weak, and it is just getting to the point where it's testing that weaker side of it. The last time it got to 0 was here at the beginning, the first week in January. Be interested to see if it holds here or if it goes lower, and then it might start to look like some of the previous more corrective periods going back here, looking during this uptrend. But this is one chart I would be looking at to see which is which. The second one, we didn't talk a ton about asset allocation in this show. However, it's worth noting that bonds are just threatening to show a pretty positive breakout here. So this is looking at what's really a descending triangle pattern. This is a nice rally into the August highs. Then we have a successive period of lower peaks, but a consistent support level. That's called a descending triangle, where you have a consistent support level, lower highs. This is actually resolved to the upside. So this support level has held. The 200-day has not been touched. It's now back above the 50-day, back above trendline resistance, just starting to break above its most previous swing high, which means higher highs, higher lows. Overall, is this the beginning of further upside in bonds? And this is something I'm certainly going to be looking at, especially with stocks so extended like Greg was showing moments ago in his chart. The third chart of the 3 in 3 is commodities. So don't look now. Commodities have actually weakened pretty quickly. They're in this beautiful breakout pattern. I remember talking about this at the end of last year, going into the holidays, thinking, all right, this is an emerging a theme of commodity strength. This is going to catch a lot of people off guard. Energy could be huge, but look at how commodities have just reversed on a dime in 2020 year to date. Just these first couple weeks really weak, and now back below the 200-day moving average. Most noteworthy to me is the fact that the RSI has now broken below the 40 level, which puts it more in the bearish corrective range as opposed to more of the bullish range. So I think a chart of the GSG or the CRB index, some broad commodity index, might be a really interesting one to watch. But folks, that is the end of our show. Thanks so much for joining us today and every day after the close on the final bar to look at the charts, think about the long-term trends. I want to thank my guest, Greg Harmon from Dragonfly Capital. You can get to him on Twitter @HarmonGreg. Fellow Clevelander, thanks again, Greg, for coming on the show. Please keep your questions and your feedback coming. The final bar at StockCharts.com is the best way to get your questions to us. We'll be doing another mailbag segment at the end of the week, and we'd love to include your question. For StockCharts in Redmond, Washington, I'm Dave Keller. Have a great night.